Welcome to this brand new explainer on the Gap Advisors Ind AS Clinic YouTube channel. Look, I am absolutely thrilled you're here today because we've got a genuinely fascinating compliance mystery to unpack. Now, real quick before we jump in, just keep in mind that all views expressed here are my personal views, and they're not binding. You'll definitely want to seek the help of an expert before taking or refraining from any action based on what we discuss. Oh, and for context today, our reporting period runs from the beginning of April 1st to the end of March 31st. And our functional and presentation currency is the Indian rupee, so any currency other than that is a foreign currency. All right, let's dive right in. So here's our agenda for today. We're going to start with a financial statement mystery, then look at the rule of reclassification, the trap of obscured information, the verdict on disclosure, and finally, wrap up with expert tools and next steps. Section 1, a financial statement mystery. All right, so our story today actually kicks off with a proactive, suo motu, independent review of a listed company's published Ind AS financial statements, which were downloaded and reviewed independently by Gap Advisors. Now, when you pull up published financials, you naturally expect a pristine, clear window into a company's financial health, right? But while conducting this review, we hit this exact note. Previous period or year figures have been restated, regrouped, and rearranged wherever necessary. I mean, at first glance, if you're just quickly skimming, you'd probably think, sure, standard boilerplate, no big deal. But to an informed eye, this vague wording is a massive red flag. In fact, it was the primary clue in our investigation. Why? Well, because it tells the user that things have absolutely changed, but it completely fails to explain the who, what, where, and why of those changes. Section 2, the rule of reclassification. To truly grasp why that seemingly harmless boilerplate note is frankly deeply problematic, we've got to look at the rulebook. Paragraph 41 of Ind AS 1 explicitly states that when an entity changes presentation or classification of items and reclassifies comparative amounts, they can't just casually wave a hand and say, oh, things were rearranged. Nope. It must clearly disclose three very specific things. First, the nature of the reclassification. Second, the exact amount of each item or class of items reclassified. And third, the reason for the reclassification. And yes, this includes doing so as at the beginning of the preceding period. Listen, comparability is literally the bedrock of financial analysis. If a user is comparing year over year, they need to know exactly what shifted and why. Otherwise, the comparison is entirely meaningless. And that vague note we just looked at, it completely fails on all three of these requirements. Section 3, the trap of obscured information. Now, I know what you're thinking. A company might try to defend itself, right? They might say, well, hey, we didn't omit the information. If you look really, really closely, the specific reclassification details are scattered in various other notes throughout our 200-page document. But what happens when a company claims these details are just kind of scattered elsewhere? Well, according to paragraph 7 of Ind AS 1, that defense is a resounding no. Information is officially obscured if it's communicated in a way that would have a similar effect for primary users to omitting or misstating that information altogether. Just think about that for a second. The standard is actually telling us that hiding information in plain sight or making it incredibly difficult to piece together is treated with the exact same severity as just leaving it out entirely or straight up lying about it. And the standard definitely doesn't leave this up to interpretation either. It provides some really concrete examples of circumstances that lead to this trap. For instance, it warns against using vague or unclear language, which is exactly like our rearranged wherever necessary clue. It warns against material information being scattered throughout the financial statements. It warns against the inappropriate aggregation of dissimilar items, or on the flip side, inappropriately disaggregating similar items. And it explicitly warns against hiding material information behind a giant wall of immaterial data. Basically, if a primary user cannot determine what information is material because it's completely buried, well, the disclosure has failed its fundamental purpose. Section 4, the verdict on disclosure. So let's bring it all together and see how this builds our final case. We have our initial clue, and we've got the crystal clear mandates of paragraphs 41 and 7. It is time to render a verdict on this listed company's disclosure approach. Let's look at the side-by-side reality here. A genuinely compliant disclosure is detailed, it's specific, and crucially, it utilizes clear cross-references to connect related data. Like, if you have a general note about reclassification, it absolutely must direct the reader to exactly where the nature, amount, and reason are detailed. But the company we reviewed, they relied heavily on scattered information. Because there was a total absence of proper cross-referencing, the details regarding the reclassification were just scattered all over the financial statements. So our verdict is pretty clear. The company disclosed information in the notes in an obscuring manner. They fell right into the trap. Section 5, expert tools and next steps. Look, applying these accounting standards correctly and actively avoiding these super subtle traps of obscured information can be incredibly challenging, but you definitely don't have to navigate it alone. Gap Advisors provides a really comprehensive suite of resources to ensure you stay compliant. First off, I highly recommend checking out the issue repository on gapadvisors.com. It currently hosts over 4,500 issues and their detailed responses on Indian accounting standards and Indian GAAP. Any person can register for completely free and submit issues for a detailed response delivered directly to their email inbox. This is a particularly invaluable tool for auditors out there who need to strictly document exactly how they addressed any specific issue relating to the application of Ind AS. It is basically a goldmine of practical, applied knowledge. Furthermore, you should know that the specific observation we discussed today was actually featured in the 225th edition of the Gap Advisors Task Weekly newsletter. This newsletter is brilliantly authored by C.A. Manish C. Iyer, director at Gap Advisors and published on LinkedIn. To date, there are over 230 published editions. So if you are registered on LinkedIn, do yourself a favor and subscribe to this newsletter for free. It is consistently packed with high-value insights exactly like the one we covered today. And honestly, perhaps the most actionable step you can take right now, please don't risk signing non-compliant financials. You can actually get your financial statements independently reviewed by Gap Advisors before you sign them. All you have to do is submit your financial statements in a near-to-publishing PDF format by email to info@gapadvisors.com. Trust me, having an expert, independent set of eyes look over your disclosures can literally be the difference between a compliant report and falling into that obscured information trap. If you want to go even further into the weeds on this, I'd love to invite you to connect to the Gap Advisors Ind AS Clinic podcast. It's available on Spotify, Amazon, or right here on YouTube for a true deep dive into the observation we dealt with in this explainer. Also, if you found this analysis helpful, please take a quick second to like and add comments on this explainer, and make sure to subscribe to the Gap Advisors Ind AS Clinic channel if you aren't already subscribed. Lastly, please share this explainer among your contacts, your colleagues, and your audit and finance teams to help us spread the knowledge of Indian accounting standards. All right, we sincerely thank you for your time today. As you head back to your desks, your audits, and your financial reporting, I want to leave you with this one crucial question to consider. Seriously, go look at your own disclosures. Are your reclassifications fully transparent, providing the nature, amount, and reason clearly? Or are they just hiding in plain sight? Thanks so much for learning with me today, and we'll see you in the next explainer.